Good day and welcome to Canary News Daily News Update. Federal Reserve policymakers reached a consensus last month, indicating a commitment to maintaining a restrictive monetary stance for some time. Acknowledging the likelihood that they were at the peak rate, officials signaled an intention to begin rate cuts in 2024. According to the minutes from the December 12, 13 Federal Open Market Committee meeting, participants believed the policy rate was likely at or near its peak for the current tightening cycle. However, they emphasized the need for policy to remain restrictive until inflation showed sustained and clear movement downward. The minutes revealed a growing optimism among participants regarding the trajectory of inflation, noting clear progress. While the committee expressed a willingness to cut the benchmark lending rate in 2024 if this trend persisted, there was no indication that easing could commence as early as March, as suggested by futures traders. The quarterly projections implied the possibility of 3 interest rate cuts in 2024, totaling around 75 basis points of cuts. Despite a unanimous vote at the meeting to maintain the benchmark lending rate in the range of 5.25% to 5.5%, the FOMC's forecasts signaled the conclusion of an aggressive tightening cycle. Individual expectations for the federal funds rate at the end of 2024 varied widely among officials. The Fed's dot plot indicated that 8 officials anticipated 2 quarter-point cuts for less, while 11 officials expected 3 or more. A modification to the Fed's post-meeting statement underscored the shift in tone, emphasizing a commitment to monitor data and developments to assess the appropriateness of any additional policy firming. While futures markets anticipated 6 rate cuts in 2024, beginning with a quarter-point reduction in March, some Fed officials have pushed back against expectations of an imminent policy move. Federal Reserve Chair Jerome Powell cautioned against premature celebrations, acknowledging discussions about when to start dialing back policy restraint. Despite a slowdown in rate increases last year and a considerable easing in inflation to 3.2%, officials noted a high degree of uncertainty in the economic outlook. The labor market has remained relatively robust, with average payrolls growing by 204,000 over the most recent 3 months. However, persistently strong wage gains or unexpected economic growth could pose challenges to the progress of inflation toward the central bank's target. The latest projections suggest the economy expanding at a slower rate of 1.4% in 2024, with minimal impact on jobs. In other news, oil prices surged, following a more than 3% increase on Wednesday, as disruptions in Libya and attacks in the Middle East heightened tensions in the crucial crude-producing region. The global benchmark, Brent, hovered around $79 per barrel. In Libya, protesters halted production at the OPEC producers Sharara and El Feel fields, which typically contribute around 365,000 barrels per day. The situation in the Red Sea added to market concerns, with Houthi militants claiming responsibility for an attack on another merchant ship this week. Geopolitical tensions in the Middle East and Libya have reversed the early-year decline in oil prices, potentially reintroducing a conflict premium. Oil prices had fallen by approximately a fifth in the previous quarter due to increased production from non-OPEC plus sources, such as the U.S., outpacing demand. Morgan Stanley adjusted its forecasts, anticipating non-OPEC supply to outpace global demand in 2024. However, they expect OPEC plus cohesion to provide support, maintaining oil prices within a range of $70 to $90 per barrel this year. Coming round to tech news, Apple Incorporated, already the least favored large tech stock on Wall Street, faces increasing concerns about iPhone sales, resulting in a second downgrade this week and solidifying analysts' cautious stance. On Thursday, Harsh Kumar from Piper Sandler and Company lowered his rating for Apple, pointing to a weak macro environment in China that is expected to diminish demand for iPhones. This downgrade comes shortly after a more pessimistic move by analysts at Barclays plc led by Tim Long, who downgraded Apple to underweight on Tuesday. As the tech giant entered 2024, it already had the fewest number of bullish recommendations among big tech stocks, according to Bloomberg data. Piper Sandler's recent downgrade further diminishes Apple's buy-equivalent ratio, reaching a 3-year low and reflecting the heightened skepticism among analysts regarding the company's prospects. That is all the time we have today. Tune in again tomorrow for the latest news and remember to like and subscribe.